Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. A 60-day ceasefire between Israel and Lebanese militant group Hezbollah comes into effect. A first step towards ending a conflict that's killed at least 3,000 people and displaced more than 1 million. The new cabinet takes shape in a sign of his commitment to tariffs. Donald Trump picks Jamieson Greer as trade representative and Kevin Hassett as for the National Economic Council. Plus, French Prime Minister Michel Barnier says the country faces a storm in financial markets if his government loses a no-confidence vote.
In the meantime, a quick check on these markets. When you look at the futures picture, you are seeing underperformance in the Euro Stoxx 50 futures, down by about 0.2%. The FTSE 100 we will call flat there, but the U.S. 10-year hovering around that 428 level, down about 2 basis points. Some interesting levels we're going to be talking about in the bond market, but that tariff story looms large, specifically over the Chinese yuan, continuing to see some weakness there. 726 on that currency pair. The countdown to the opening trade starts right now.
Wednesday the 27th, good morning. Last day of the week. The Americans, I understand, are going to be on holiday tomorrow. That's likely probably to take a little volume out as the session progresses as we work our way towards the Thanksgiving holiday. Before we do all that, though, we've got plenty of things we need to be thinking about. We get a big data dump out of the United States as all the data is compressed into today that we normally would have got for the rest of the week. We've got to be thinking about what is happening with the latest round of Donald Trump appointments. And we've also, Anna, got to price in a ceasefire in the Middle East. Though, judging by the market reaction this morning, I would say that looks already priced.
Yeah, absolutely. And so we've got a nice chart that shows gold and oil over the last few days, and you can see that the market saw this coming. Still, no downplaying the good news that it is that we have now, I think 5 hours ago, started this ceasefire. So will it hold is one of the key questions, of course. Hezbollah is required to remove its troops from an area of southern Lebanon that it was supposed to remove them from back in 2006. What kind of support can the UN and the Lebanese military provide there? This has been welcomed by Iran, of course. Anthony Blinken talking about how this might help to make progress in Gaza. Other voices seem much more sceptical on that front, though.
Is this basically just getting the deal done before Trump comes in? That kind of feels what it is right now.
I was literally going to say that. It's a 60-day ceasefire. 60 days gets us to the first week that President-elect Trump takes office. So January 20th, he takes office, and the next week, the ceasefire expires. So this was something that we know that Benjamin Netanyahu had spoken about, making kind of an early policy gift to Donald Trump. That's a direct quote as well. So we'll see what happens come January.
The Biden administration obviously hoping that this turns into something more lasting, and so perhaps wanting to make this one of the first foreign policy tests for a new president.
One area we may see some reaction in this is the airline sector. So the airline sector, particularly the likes of EasyJet, which is reporting numbers this morning, those numbers just dropping onto the tape as we speak, have been impacted by the fact that they haven't been able to fly into the region, and it's therefore affected their numbers over the last few quarters. If we do see a deal getting done, does that start to have an impact? Gaza was obviously the initial impact, but the war with Hezbollah has had a more lasting, or has had a further impact in terms of the numbers. So we'll speak to Johan Lundgren. We'll get his take on that very shortly.
And we were speaking about, of course, the Trump effect, and that's showing up potentially around these Middle East conversations. Also showing up, of course, in this tariff overhang. That was really the last story that kind of dominated the markets, or at least the sentiment in the last 24 hours or so. Since then, we've got feedback coming from the Mexican and the Canadian presidents as well, and Prime Minister, I should say, for Canada, talking about what this could actually mean, what they could offer in return. Some of that includes reciprocal tariffs. But I thought it was interesting. You're starting to see a lot of the Wall Street banks come out with research suggesting this is ultimately, surprise, inflationary. Things that, like gas prices, for example, in the U.S. could go up. Gasoline prices, I should clarify, by as much as 75 cents. That is a big deal for an American consumer. Does that change the thinking at the Fed?
Yeah, that's the Goldman Sachs line, isn't it, when referencing imported fuels coming through from Canada. Really interesting. Yeah, I mean, this just the fact we've had the conversation already about retaliatory tariffs, both from the Mexicans and the Canadians, does play to the bigger concern here that if everybody else in the world follows the United States lead, then that's when you get into that real sort of inflationary spiral, perhaps. Really kind of almost quaint that the Mexican president talking about wanting cooperation and not hostility, which, you know, this is going to be a new era.
Haven't you read the book?
Yeah, we have a playbook to go with here, and cooperation is not the name of the game.
But does that price mechanism limit the White House's desire to do some of these deals, or not put these tariffs on. Lumber prices are also sharply higher as well. That's another area you could be seeing the Canadian impact coming through. If gas prices do rise, does the White House rethink? So
that's the gas prices. We talked about cars and the impact there yesterday for some of the European players as well. Then there's alcohol and there's avocados. And for me, I always like to talk about Chipotle stock when talking about avocados, because that's the one that's very aggressively exposed to it. And Chipotle stock actually rallied yesterday off of the back of this. And I thought that was interesting. Is that a potential play? Either that's complacency in the trade, or there's a potential play in the ability for consumers to eat those additional costs.
Have we reached peak avocado?
No.
Never. Never.
Definitely not. That we probably should. I joke. Let's talk about what's happening in France. Kriti, you were talking about this with Tom just a few minutes ago. So there's reporting out from the Parisian, the newspaper, saying that Macron has suggested that actually he expects the government of Barnier to fall. Now, the Elysée has pushed back quite hard on this. Le Parisien is standing by its reporting, but Barnier was out yesterday warning that we could potentially see a storm coming if this budget is voted down, and his government, by extension, is therefore voted down as well. Spreads have been widening out. We're at 85 bips over Germany right now. How much higher do we ultimately go? We've also got this court case coming to a conclusion today. We don't get a verdict in terms of Marine Le Pen's political future. So all of this kind of coming together. The market is clearly very nervous. How much more nervous does it get?
Yes, I wonder how the court case plays in. Understand we might not get firm news on that in January, but this might all come to a head before then in December. How high the spreads go is one that many have been weighing in on. I know our stories have quotes from Citi talking about it going to 100 basis points. As you say, it's 85, 86 right now, which is the highest close since 2012. And we all remember where we were in 2012 and what spreads were doing then. But we have other voices in the mix. Allianz saying it could go as high as 125, which would put it on a sort of level pegging in terms of spreads with Italy.
Yeah, that's a scary metric. That suddenly there is a risk that people are even talking about this. The likelihood is that the French premium could actually exceed that of Italy's or be on par with it. To me, is wild, given how much liquidity there is in the oat market.
What we don't know is what comes next. If the government falls, what
just another try? I mean, quote unquote, just, but another attempt to cobble together a budget that's more palatable to Le Pen.
No, a new government. Who do you bring in as prime minister? You start the whole process again. Do we get another government that's lasted the last 2 or 3 months? What happens in the interim?
But all under the same president.
Oh, yes.
Yes.
In theory, we'll wait and see. But it is going to be a real challenge, and you don't know how the mechanics are going to work in this kind of scenario in France, how the budget would work, how a prime minister may be able to function in that kind of space. Anyway, we've got plenty to talk about on the show. We've already mentioned what might be happening with some of the airline stocks today. Another factor that could weigh or impact that area this morning could be the EasyJet numbers, which are dropped on our screens. They look like they've met expectations. Johan Lundgren, the outgoing CEO of EasyJet, is going to be joining us for the last time. Caroline Shaw, multi-asset portfolio manager at Fidelity, will be joining us around the open. Jim Reed, head of global economics and thematic research at Deutsche Bank, joining us, Kriti, in the second hour of the show.
He's got some interesting takes on the markets and technology as well. We're excited for that conversation. Let's talk about what else we're going to be watching out for today as well. As Guy was saying, that we do have a little bit of a data dump throughout the rest of the day, but it kicks off at about 9:30 a.m. right here in Europe. German consumer confidence numbers are going to be hitting the wire. And then at 11 a.m., an approval vote for the new EU Commission. Can they get to work before December 1st and certainly get ready for the new year as well? And then, of course, like I said, that data dump, we've got U.S. third quarter GDP, 1:30 p.m. That is the second print there. Initial jobless claims at the same time. And then just 90 minutes later, U.S. core PCE numbers coming in at about 3 p.m. UK time. Yeah,
and amongst that, yes, the PCE data, and expecting that to tick up slightly. Bloomberg Economics describing this data point as another reason why the Fed could be careful in December. What does careful mean? I mean, there are some, and Bloomberg Economics is amongst them, who are thinking about maybe there's a pause in December.
The market is basically pricing a pause. We're almost there in terms of what the market is signalling. We've significantly downgraded December in terms of the pricing. Low conviction, I think. And then what happens? What happens into New Year when you start to gain clarity? The minutes didn't really give us much, and they certainly didn't give us much in terms of the Fed anticipating that we're going to be seeing sort of proactive action, proactive decision-making around what Trump is going to do. They look like they're going to wait and see.
I'm confused about these markets, though. What are the markets trading off of? It feels like the volatility around some of these data points has come down a little bit. Are you then just looking ahead to your point about the further impact? But then how do you price that in? I would love to get a quant on the show and say, explain the math.
I have one word what markets are trading off at the moment. Isn't it Trump?
Oh, I was going to say vibes, but, you know, sure.
Trump vibes.
Trump vibes.
We'll go with both of those. What else do you need to know this morning? Let's work our way through what we should also be looking at. The Netherlands has accepted changes to its budget after consulting with the Commission in Brussels. The initial submission by The Hague exceeded the fiscal spending growth limits set by Brussels back in June. CrowdStrike shares slumping after hours following weaker-than-expected earnings forecast from the cybersecurity company. The numbers disappointing investors watching for signs that the firm has recovered from its flawed update that, remember, crashed computers around the world last summer. That outage, which I think was back in July, disrupted industries, including air travel, banks, healthcare, etc., etc., etc. And Bloomberg has learned that BYD is asking suppliers to accept a 10% price cut starting in January, signalling the car company is itself positioning to weather an intensified price war in China's auto market. BYD has so far come through some of these price pressures relatively unscathed, leading a round of industry-wide price cuts earlier this year, delivering record revenue and income on the back of it. The Chinese are going to become more competitive. That's music to the ears of European automakers.
I know, I was going to say, we spend a lot of time when we think about Chinese manufacturers talking about their impact on Europe, and no doubt that will come, and that stems from what we're discussing here. But this initially within the Chinese market, very much worth reflecting on, the weakness in pricing in China and reflective of the wider concerns about the Chinese consumer.
Yeah, it's fascinating, though, that it just brings back memories of the idea of the kind of pricing cartel that the Chinese had with 16 EV makers, including Tesla. And I'm curious if that's where you go back at some point when it comes to this kind of international competition. It didn't, but I'm curious if this kind of creates that incentive. If everyone cuts their prices, everyone follows this lead, do you have a kind of price war to the bottom almost?
Or is it just a Darwinian process that ultimately sees the weakest getting shaken out of a market that is increasingly being dominated by names like BYD?
Meanwhile, here in Europe, we are still seeing a lot of criticism from some of the automakers around the stringent EV sales mandates that we have in various parts of Europe, and that being cited by Stellantis as one of the reasons why they are cutting back on their production in the south and moving some of that production to the north of England, to Ellesmere Port. So big news in the autos sector. It's 11 minutes past 7 here in London. Coming up on the programme, we will not take our eyes off the banking saga. Banco BPM rebuffs an unsolicited approach by rival UniCredit, saying its takeover proposal wasn't agreed in advance, is too low and would likely hurt jobs and competition in Italy. We will discuss that unfolding story in Italian banking. Plus, the CEO of UniLever says the consumer giant exited Russia because it was losing control of its business. We'll bring you some of our interview with Heinz Schumacher later in the programme. Up next, we're joined by Jumana Salaheen, who's Chief Economist for Europe at Vanguard Asset Management. If you have any questions, if you do want to get involved in our conversations, IB plus BBTV Go, that's the function to use on the Bloomberg terminal. This is Bloomberg.
We are, 43 minutes away from the start of the opening trade here in Europe. In terms of what we're anticipating, as you can see, fairly quiet session, I think, probably will likely unfold. We've got a lot of data that we need to be getting through and thinking about how that's going to impact the markets post-Thanksgiving. I think we'll have a few days to digest it all. Anyway, minutes from the Fed's November meeting show policymakers prefer a gradual approach to future rate cuts. Let's figure out what it all means. What did we really learn from those minutes, Valerie Teitel?
Look, there was a repetition of this word gradual when it comes to lowering rates. There was broad support for gradually lowering interest rates. We also saw some quotes about the downside risk to growth moderating. We heard this directly from Powell in his testimony. It'd be interesting to also see that he had a broad support for lowering those downside risks to growth. Maybe a bit niche, but this was a surprise here down at the bottom that they are looking at lowering the rate on the reverse repo facility, a guy that could potentially be the Fed having their eye on the year-end turn, not wanting to have a repeat of what happened at quarter end when we did see a funding spike in SOFR futures. We are still pricing a 50-50 chance of a Fed cut in the December meeting, but perhaps the U.S. data today can take us in another direction. We get growth data, labor market data, and inflation data. This PCE is going to be the most important of the day, Guy. Any upside risk in this inflation indicator could prompt the market to further price out that cut from the Fed when it comes to December. I also want to point out something that I found very interesting from the consumer confidence data we had out yesterday. Not only did consumer confidence hit the highest in 16 months, but we also saw a record high for this stock market optimism index. It's the percent of respondents who think the stock market is likely going to be higher over the next year. It hit a record high, surpassing the previous highs in early 2018, and that was around the optimism of the original Trump tax cuts proposals when it comes to corporate tax. So a lot of optimism out there around what this new Trump administration could do when it comes to deregulation and tax cuts, and it seems like the market is very bullish underlying this equity market sentiment. Momentum.
That certainly seems to be adding further evidence into that momentum story. Valerie, thank you very much indeed. Let's talk more about this. Jumana Salaheen, Chief European Economist at Vanguard, joining us around the table. Good morning.
Good morning. Thanks
America,
for having me.
nice to see you. America looks great. Europe looks like it's heading in the opposite direction. Is that the basic takeaway from what we're seeing out of the data at the moment?
I think that would be a fair thing to say. And I think if you look back to the evolution of the growth outlook through 2024, the US has become more and more optimistic and Europe has been more pessimistic. You've seen that divergence in growth. And really, this is really important, is the US has faced lucky supply-side shocks. What do I mean by that? Productivity has been better than expected, and labor supply from immigrant labor, 5 million immigrant workers from 2021 have come in, and that's added to the supply capacity of the economy, which is why we saw those Fed minutes saying, you know, we see good news on growth.
Anything going to change this?
Anything, probably, we don't really know. Obviously, we've got, you know, there are expectations of policies coming through with the new president next year. We don't know. There are downside risks.
Is he going to reinforce those moves that we've seen thus far, or is he going to maybe detract from them? Does America stay lucky?
It's definitely going to stay lucky in the near term, right? So some of these forces, these structural forces, the supply side, the workers being there, productivity, they don't disappear overnight. And even any kind of new policies will take time to embed. So it's not going to go away immediately, potentially down the line. There are downside risks. And the big question is, you know, to what extent? What is the magnitude of those risks?
And Jumana, good morning. So this sets up big divergence then between the economies of the United States and the Eurozone or Europe more widely. How big does that divergence get?
So it gets, you know, it gets pretty big. Some of that is related, obviously, to domestic factors. Some of that's related to global factors. So trade policy uncertainty, economic uncertainty about policy, that's actually gone up. It's nowhere near the highs that we've seen historically, but it is elevated. So what does that do? When there's policy uncertainty, investors don't invest, consumers don't consume, and we've actually seen in the PMIs and some of the confidence surveys in Europe, it's gone down. So in terms of numbers, what are we looking at? We're looking at euro area growth of around, 0.5% next year, and for the US, more like 2%.
Yeah.
So pretty big divergence. Some of that is structural, though, right? So in a really good time, you wouldn't expect the euro area to be more than 1.5. So the trend growths are quite different.
Yes, but this is exacerbating what you see in a sort of underlying sense.
Yes.
So that's the picture in terms of the amount of divergence that we're going to see. Where does that take us on the underlying growth story in Europe in terms of the ECB? Because, that could be supportive, ECB cutting rates. We could see higher real wages having more of an impact in parts of Europe. Are those things, as people start to forget the really, really high inflation days, are those things going to be positives for Europe?
Yes, so that will be mildly positive for Europe. I mean, central bank policy can only help through the cycle, right? So you have your trend growth, that's different. But central bank, we do see the ECB cutting rates, and we see ECB cutting rates to below what we call neutral, so much more dovish by the end of next year, below 2%, whereas the Fed, we don't see it cutting rates below 4%. So that's quite a divergence from the growth down to the policy side. The policy will be slightly stimulative, but it takes time. So you've heard of the long and variable lags. It's not going to be that silver bullet.
And the real wages?
The real wages side, obviously, real wages are improving in Europe because inflation is coming down. But, we do see wages still remaining sticky. In real wage space, it probably is going to be a much better story and supportive for consumption.
Jumana, in the States, there's a conversation right now around, obviously, tariffs and what that's going to do to prices for the American consumer, for wages, et cetera. Essentially, inflation could tick up under, even just in the first year of Donald Trump's presidency. How much of that feeds into Europe or bleeds into Europe when it comes to inflation numbers here?
So just like tariffs will, push up on inflation, I mean, that's the theory, and that's what we've seen as well in the U.S. You see the same thing in terms of the channels of transmission. If there are tariffs in Europe, you will see those price pressure, nothing else changed, being higher. But, if we do see a weakness on the growth side, that pushes that inflation down and it broadly offsets each other. So the tariffs push up, weaker demand pushes down. So in terms of the inflation impact, it could actually be very muted.
For Europe.
For Europe,
that's pretty
right.
fascinating. But then how does the fiscal story fall into all of that? I'm just curious what drives kind of European growth. Is it the cuts from the ECB, as Anna was mentioning, or is it, say, fiscal stimulus from some of these governments in France or the Netherlands or Germany? What drives it, the fiscal or the monetary?
So the monetary will only be cyclical, short-term horizon. The fiscal, it depends. If it can actually unlock the structural side of the economy, like the Draghi report talked about, investing in infrastructure, technologies, AI, that can move the dial on the structural growth rate.
You worried about France?
France.
What happens if the French government falls and spreads widen out significantly in France? Is that a idiosyncratic French story, or is that a Eurozone crisis story?
I mean, if it is to do with French politics, then of course it will be related to a French story, not a Eurozone story. But given that it is part of the euro, depending on the extent of that, depending on the length of that, whether they could actually sort it out, then it could just be a temporary thing and not spread to the wider euro area.
We had some people yesterday say, I think it was Commerzbank advising reducing exposure to France, and it is obviously about the politics, but also saying it's about the macro environment. So the PMI data at the end of last week looking so shockingly bad, surprisingly so, from France.
Yeah, I think some of the French stuff is the post-election down, so the base effects, if you like, so probably not enduring. But, we know that there are some structural issues in France, and we know that the credit spreads and the spreads have been a little bit higher than before those problems came to light.
So that was France. Let's talk about Germany as well. We might have a removal of the debt brake going into next year. What does that do? How much of the growth does that stimulate, as is, of course, the goal?
I mean, I think it really depends on, going back to what we were talking about earlier, how much of that fiscal can be put into those structural, the technologies, the AI, the forces that really drive growth, and in an enduring way rather than a short-term way where, it's in and then it's out.
Certainly something we're going to be keeping a close eye on. Jumana Salaheen, Chief European Economist over at Vanguard Asset Management. Guyana, it's fascinating that we're talking about this doom and gloom in Europe. We have been for quite a bit now.
Yep.
And yet there are almost like some moments on the horizon, perhaps, for both France, for Germany, where maybe they can wiggle themselves out of this.
Can you point us in those directions?
Sure. If the yes, I can. I'll be the ray of sunshine on this show. If you have this budget magically go through, if the debt brake gets removed, and you have investment from the German government, I admit
we're relying on magic now.
I'm trying. I think as journalists sometimes we can be a little doom and gloom, but Europe has survived crises before, and they'll survive another one.
Forged during them.
Yeah, in fact, it almost needs a crisis.
Always.
You do
Always.
wonder whether that's where the progress is now going to come from.
Coming up on the programme, we'll be joined by the CEO of EasyJet, Johan Lundgren, will be with us as the airline reports full-year earnings. Lots more on aviation next. This is Bloomberg. Welcome back to the opening trade, everybody. 30 minutes until the start of trading here in Europe. Let's look at the futures picture then, put that up on the screen and show you what that does look like for today. So the European futures picture looks flat to negative. The US futures picture looks pretty flat. We're going to get a lot of data out of the United States a little bit later on, whether that's PCE on the inflation front or the GDP prints. That's something to watch, but really we're very much focused on the new administration in the US and waiting for new headlines probably to come from Truth Social, frankly. Let's have a look at what's happening on the bond markets, because there's a big area of focus for Europe right now. The French spread closing at 86 yesterday. It's around that level this morning as bond markets just open up here in Europe, looking to see if we get any movement on that as we watch the French politics very, very carefully, Guy.
Let's talk about the numbers that we're getting out also this morning. Earnings season continues. EasyJet, the last of the major European carriers to report numbers. They look pretty much in line with expectations. The company talks about, quote, strong progress when it comes to its medium-term targets. The standout, though, is that we have seen a doubling of the dividend to 12.1 pence per share. We're joined by the outgoing CEO of EasyJet, Johan Lundgren. Johan, always a pleasure. Thank you for the time this morning. Let's talk about why you're confident enough to double the dividend. What's behind that decision?
Well, I think it's the progress towards the targets that we set out here just a little bit more than a year ago. On practically every metric, we have been able to report a very strong progress on that. We have had a record summer beating last year's record summer. We managed to reduce the winter losses in the airline, and EasyJet Holiday, as you know, is growing phenomenally and does very well for us. So that's the reason why we're going from the 10 to propose 20% of returns to shareholders.
Johan, do you think you've been a lucky airline CEO of late? You seem to have the perfect platform in which to take on the competition. You have Airbus A320s, variations of, and CFM engines. Nobody else has that combination in Europe. They've either got Boeing aircraft or they've got Pratt & Whitney engines. Is that the secret sauce?
Well, I think that in all fairness, all the manufacturers, whether that is Airbus and Boeing, are struggling with their supply chains as well. And whilst we've had all the 16 deliveries in 24 that we expected, we're getting 9. We should have had 19 as a matter of fact, but we're managing the growth trajectory anyway, and we can allocate also within the network to make sure we have the capacity where the demand really is as well. But I think this is down to a constrained chain overall. But you're right to that extent that the engine choices that we made and also then going with Airbus is a better alternative than some of our competitors are having. I thought we were going to say that was down to the excellent geniuses of the management and the board to make those decisions rather than luck. But anyway, there we go.
Maybe those two things go hand in hand.
No, we have a constructive relationship with Airbus, and we're very pleased about the choice with the manufacturers.
Talking of the manufacturers, let's extend and talk a little bit about what happens next. How do you make this business better? How does your successor, your current CFO, Kenton, step into the role, and what do you think he has to do? Is there a way of making the EasyJet holiday business better? Should you be looking elsewhere in the world rather than simply looking at Europe? People are talking about the Caribbean as being an obvious maybe next destination for EasyJet. What do you think the future holds?
Well, I think, certainly in the airline, we will continue to focus on flying, short haul. But having said that, we see phenomenal growth into North Africa. We launched Cape Verde as an example as well. So, we are flying further distances. That's true. But that's really driven by the demand. But EasyJet Holidays is on a fantastic trajectory. But remember that they still only sell about 7% of the airline's capacity. So there's still a huge number of customers that we can convert into the holiday business as well. And Kenton going to set out today in the presentation we're going to do later on with the analysts and to investors also the exciting things that is ahead of them. EasyJet is in a strong position. I mean, we have the customer satisfaction score that is among the highest we've ever seen. We are rated as #1 airline in Europe on ESG, undisputable leader in there. We're ranked as the #1 airline to work for in Glassdoor. It's on the Times Best Companies to Work for, big companies list as well. So there's a lot of things that we have done done well so far, but there's always things to do. Kenton wants to continue to focus on resilience, providing customers with great fares, and then also, easy and reliable flying. And that's what he will continue to focus on.
Johannes Kriti in London, you talked a little bit about your expansion programs or thoughts there as well. Talk to us about cutting routes as well. Your competition, Ryanair, is certainly doing that. Is that something EasyJet is considering?
Well, we're always optimizing the network, and that's really driven from where we see customers want to fly more from and where we see less demand is coming in. So there's always an optimization of the network, but we clearly see, strong demand into leisure, into beach destinations. We see strong demand into North Africa destinations, slightly less when it comes to cities right now. We're cutting back some of the domestic routes across the network that we had, but in the UK, as an example, we're opening up our 10th base here in Southend this spring as well. So we have the ability with all the aircraft we have to allocate those aircraft where we see the demand is as well. So we're going to be able to manage the demand that is out there. But that's something we do on an ongoing basis.
Johan, Ryanair has been quite vocal about the impact of increasing air passenger duty and saying that's the thing that might get them to review some routes. Is that having an impact on your thinking? How significant is that increase in APD?
Well, first of all, I should say that I do think it's disappointing that this tax get increased. It's coming in from 2026 here. But the reason why I'm disappointed at it is that it goes completely against what we are actually believe is the right thing to do, that the UK government is doing, is focusing on economic growth. And we've seen a number of countries who are focusing on economic growth that actually have reduced and removed this type of tax to actually add on additional tax on the consumer straight on. That is not going to be helpful in terms of what they're trying to achieve. But the government has many priorities to make, and they get difficult decisions to make. But this was not a good one because it goes against what they're trying to achieve.
We know that you're going to be moving on, Johan. We've talked about that already, and we look forward to interviewing your successor on this programme. When you look back at your time at EasyJet, what do you think your biggest achievement was, Johan? What do you look back on with pride?
I think it's a little bit too grand to kind of write its own legacy. But look, I think, the things that we have, demonstrated today in terms of where the company is and what's clear to read to everybody, that's something that I've been privileged enough to do with a bunch of tremendously talented, ambitious and passionate people in this organization. So I've had the privilege to lead this company at a certain point in time as well. And now the company is in a very strong position as well. But also, it will be plenty of things for Kenton to do. There's all the things one can do to become a better company. And that's what Kenton is going to continue on. But in terms of legacies, somebody else will have to write that for me. But I think the results in today's results demonstrate some of that.
Surviving maybe the total shutdown of the aviation industry during the pandemic, that certainly is maybe one thing we can talk about in the future, as Anna points out. Just quickly, Johan, it looks like we've got a ceasefire deal in the Middle East. Is that going to change your policy towards flying into the region? Do you think that will give the numbers a boost next time round if we can see maybe easier flying in that region?
Well, first of all, it's a good thing, clearly, from a humanitarian point of view as well. And let's hope that this gives some certainty and stability under improved conditions for the people that is in there. And we will evaluate that once we see that stability hopefully be in place if we resume flying into Israel. We want to resume flying into Israel and into the regions overall, but we just got to make sure that there is a stable situation before we consider to do that. But we want to do that, and when the time is right, we will do that.
Johan, it's always been a pleasure. It continues to be a pleasure. Thank you very much indeed for your time this morning and all the times you've joined us to go through the EasyJet numbers and talk about EasyJet's future. It's always been a great pleasure. We look forward to talking to Kenton, and we will look forward to welcoming you when you figured out what you're going to do next around the table next time. Johan, thank you very much indeed. The EasyJet CEO, Johan Lundgren. OK, let's talk a little bit about what is happening with the markets and figure out what is going on in terms of the story surrounding where we go next. The corporate story is kind of running out of steam a little bit. The earnings season beginning to run out of a bit of pace. But Unilever's still a focus as well.
Yeah, we spoke to them. Unilever CEO Heinz Schumacher says that the firm left Russia because it was losing control of the business there. In an exclusive interview with our very own Francine Lacqua, he also discusses the global consumer trends and plans for Ben & Jerry's. Take a listen.
It was a very difficult decision to make. I found that in my last 1.5 years, it was arguably the most difficult decision to make. But I did make it quite soon, in the sense that I wanted to create optionality for us to exit that market, and that was a tedious process. So it took us more than 12 to 14 months to come to that point that we were able to exit. And you know, at some point in September, I felt I had the optionality on the table, and again, it was difficult, but I made the decision to go, not because of the war that's going on right now, but because I felt that the control on our business was coming down. I feel that ultimately, if you're a global company, you need to have control of your operations. We need to be able to review results. We need to be able to get the cash out of the country, ultimately. We need to be able to make sure that we live up to potentially international sanctions. We need to be able to control our brands and where our brands travel. And that was something that I felt wasn't enough anymore. And I didn't see a window into the near future where we would regain that control. And that drove the decision to exit.
And talk to me about Ben & Jerry's. So the way that Ben & Jerry's was set up was also having an independent board. Will that still be the case going forward, given actually, you know, a lot of the questions that you've just been telling me about?
Yeah. No, Ben & Jerry's has an independent board, and that independent board that looks after the social mission of Ben & Jerry's only. So it's not a board that looks at the business side of Ben & Jerry's, because that's what we do, but it looks after the social mission that's there. That was agreed at the time that Unilever acquired Ben & Jerry's. It's in the merger agreement, and we absolutely respect that merger agreement. And therefore, the new ice cream company that will be demerged will respect that merger agreement.
Unilever CEO Heinz Schumacher there speaking with our very own Francine Lacqua. Coming up on the program, we stick with the corporate stories. Aston Martin looking to raise cash after issuing another profit warning. That and your other stocks to watch coming up next. Stick with us. This is Bloomberg.
Welcome back to the programme. This is the opening trade. 15 minutes then until we see markets open here in Europe, equity markets that is, of course. And we have a mixed picture really for the futures story for Europe. Not a great deal of direction, waiting perhaps for some data, maybe waiting for some more communications from President-elect Trump. With that in mind, let's get into a conversation about where we are on markets. Our Markets Live executive editor Mark Cudmore joins us for 3 minutes on the markets. And negativity around Europe, I mean, not evident particularly in today's futures, but certainly we're nervous about France. Mark, is that negative around Europe narrative making its way to where you are in Asia?
Absolutely. I certainly am getting increasingly bearish on Europe, and it's not like I've been particularly positive for a long period of time. We talked already yesterday about how this week, with the low liquidity, with month end, you wouldn't want to read too much into short-term price action. So I wouldn't want to get too carried away about the recent yield moves in France. But the longer-term story has been there. We knew about this weeks ago. We knew about it even going into the US election. We now know, going up to the budget, which is likely to come to a head in December, that it's going to get much more tense for France. The backdrop here is the Eurozone has suffered 2 years of stagnant, sluggish growth, and it looks like next year will be equally bad. So this is in a multi-year kind of slump, lack of growth. The budget situation is very, very concerning in France, and there seems an inability to impose the fiscal constraint that is needed. And I think the outlet for this pressure, this combination of poor growth and yet rising yields in some problematic cases, which adds to the stress, but a lack of real yields in Germany at the core means that ultimately the outlet will probably be the currency. So I think the euro has more downside in the months ahead.
Mark, let's turn to what is happening in America, because that appears to be where all the action is, or at least the positive action. American consumers are very, very, very bullish when it comes to stocks. Is that a reason for a bear potentially to pause and rethink?
No, probably not. As you know, having been super bullish all year, I've kind of swiveled on US stocks 2 weeks ago. And so therefore, I'm inclined to kind of go, oh, look, this will help my cause. Therefore, it's a contrarian kind of bearish signal that people are so bullish. I had a quick look at the kind of run of the statistics here. It tends to be a coincident indicator. It is shocking how bullish they are. And generally, what you find in these sentiment indicators, at extremes, they can be a contrarian indicator. But I can't claim there's any statistical evidence to back that up. So at the moment, it's a coincident indicator which matches the fact that we just had US stocks close at a record high. So sure, people are bullish right now. It'll probably turn down when the stock market turns down. It may not be a leading move.
Mark, let's talk about the EM story a little bit. We saw the Mexican peso get hammered. We've seen the yuan weaken as well today to some pretty significant records. Do you get exposure to EM right now or for the next 4 years? How are you thinking about that?
In context of that, I thought it was interesting that story out this morning on the Bloomberg terminal about, Goldman's even more optimistic on South African inflation than the government is, and kind of thinks that, the South Africa story is very good and they'll stay relatively insulated to the US story. And I think that reminds that ultimately EM is a very divergent story. I think what's most controversial might be the idea that I'm not as bearish on a lot of Asia as other people might be. I think that a lot of Asia is priced in the more negative story. If US is going to raise the expense of doing trade with America, Asia has an ability to be a little bit more insulated from that to some extent. So I think some other EMs can do well as well.
Certainly something we're keeping a close eye on. Bloomberg's Market Live executive editor Mark Cudmore joining us this morning. You get more up-to-date analysis from him and the team. Just type in MLIV Go on your Bloomberg terminals. Go from the macro to the micro. Joe Easton standing by with your stocks to watch. Joe.
Morning, Kriti. So we got some solid numbers out of EasyJet today in terms of both their passengers and also an increased dividend as well, partly due to the holiday business, as the CEO was discussing on the show earlier today. Now, the stock has been outperforming its big rival Ryanair recently, and these trends do look to support that in trading today. It is a really well-liked stock on the street. Not a single sell rating on this one, 17 buys for EasyJet. So looking like a positive outlook for those shares today. Then in terms of car makers, we've got another small downgrade to guidance from Aston Martin. Now this is related to supply issues on one of their high-end Valiant models. That's the reason for the downgrade there. But the more important thing is they've also announced another fundraising, raising £210 million in both shares and debt as well. And analysts over at Jefferies actually say this could potentially be a positive driver of the stock today as it stabilises the capital structure. So they do predict a rise. But bear in mind, at £1 a share, it is priced slightly below where it closed yesterday. Potentially, we could see a bit of weakness at the open. Already lost around half of its value this year for Aston Martin. Then in terms of video games, CD Projekt giving some upbeat commentary on their latest game, saying that they're moving into full production on the latest version of Witcher. That has been a bit of an outperformer versus the big rival Ubisoft recently. Their current numbers in the last quarter also looking pretty strong as well. But it is this latest version of Witcher that everyone's excited about for CD Projekt. Analysts over at BI today saying that this should be the next catalyst for their top and bottom lines. So the video game stock in Poland potentially in focus today. Finally, in rating, some decent moves. We've got some moves on the NatWest is a buy over at Goldman. Now, I'm actually going to backtrack here and say that these might not actually be today's, because the ones I was looking for were Nestle. They've got an upgrade at Morgan Stanley. Meanwhile, Volvo has got an upgrade at JP Morgan, and Total Energies is cut at Exxon. So thankfully, my memory is absolutely intact. Those are the ratings you should be watching today.
Very well done, Joe. Excellent memory test there for Joe Easton from the stocks team. Thank you very much for bringing us a bit of yesterday's news and mostly today's news. We appreciate it. Let us talk about some of the other stocks that could be, or the other things we're factoring into the session today. I'm drawn to the French November consumer confidence data, not because we normally hit this, because it's only 1 month of data, but when it comes in a little below estimate and you're already primed to find weakness in the French economy because of the PMIs last week, it does stand out. So the November number coming in at 90 and the estimate was 94. It's interesting, we are seeing a bit of movement on that French-German 10-year yield spread as well, widening to 89 basis points. Once again, the most since 2012. But we'll be in that most since 2012 category for a very long time, because spreads were double where they are now. in 2012.
Yeah, 1% feels like it's not an unachievable target, though. If you get any kind of a crisis in France at this point in time, we're 10 basis points away, effectively, from a 1% yield. How big a wake-up call is that going to be for France? How big a wake-up call is that going to be for Europe? Barnier is talking about a storm coming in the markets. Is France ready for that storm? How does it adjust? What happens if this government falls? So many questions surrounding France at the moment. Makes Germany look kind of reasonably easy to understand.
So what reverses it? Because we talked about this when that spread first initially widened and it overtook some of the periphery yields as well, is that the minute you do have a government formed, the minute you have Michel Barnier in place, then maybe that spread will close. And it didn't. It just kind of stayed put. So I'm curious what gets us back to the levels of pre-crisis.
If it can, if it
Presidential election
goes there, yeah.
Do you need that kind of stability maybe to come from the top? But we're going to wait a long time for that.
Yeah, I was going to say till 2027, right?
Yes,
that's a while.
And we've got a lot of German politics to deal with in the meantime, as you say, looking almost stable, which seems kind of crazy when you're heading for an election.
We've got an election coming, but it looks like we know pretty much the outcome of that.
I wonder if expectations there are a bit complacent, though, as well, just given that there's a lot of people saying, Trump and this election could galvanise Europe into some big decisions around the debt brake, for example, in Germany, but wider collaboration and cooperation. Europe will be tested, no doubt.
If you look at the stock market, though, how much of the bad news... is this all priced? Is there more bad news to price? You talk to fund managers, why would I put money to work in Europe seems to be the argument that I hear time and time again, and it's an argument that is being rolled out by pretty much everybody at the moment. What reverses that? Michael Masika on the Bloomberg's got a nice piece on this at the moment. What would turn that kind of sentiment story around? How geared is Europe for any kind of good news, providing a pop when it comes to the stock market?
So two potential arguments to that, which is one, that maybe the valuations get so cheap, you get so undersold, you can't afford not to have exposure. Similar to what we saw with China. There was such a sell-off that it was kind of almost too cheap not to buy.
But that could last for a long time.
It could. The other one would be if you start to see some more government incentives, right? If you see France or Germany or whatever increase their subsidies, suddenly you have something similar to the U.S. as well. These are all topics that we're going to be talking about, of course, for weeks, months, years ahead when it comes to Europe and the United States as well. Futures a little bit mixed right now. Coming up, it is the opening trades across Europe. We're going to dive into the details. Stick with us. This is Bloomberg.
Wednesday morning, good morning. Last day of the week, effectively the last trading day of the week. The Americans are about to disappear off on their Thanksgiving Day holiday and then go shopping on Friday. So we've got to think about what we're going to get today. We're going to get a lot of data. We're going to get a lot of squaring, I suspect, in terms of positions. This chart here, I'm beginning to wonder what the relationship is between this chart and the futures Kriti's about to tell you. Over the last few days, I feel it's kind of been relatively inexact. In theory, you would expect European futures to be popping this morning. The US market rallied into the close yesterday, but that's not necessarily what futures are signalling this morning, Kriti.
No, not at all. This American isn't celebrating Thanksgiving or going shopping, but maybe you can bring me a turkey tomorrow. We'll see if you do that. In the meantime, futures are down about 0.2% for Eurostoxx 50 futures, higher by the same margin the FTSE 100. Outperformance in the UK. But to me, I think what stands out is what's happening in the French futures story, down about 0.4%. Remember, we're seeing weakness in China, in the currency, in the stock market. Maybe that bleeds into France this morning, Anna.
Yes, absolutely, Kriti. And some of the individual stocks we're watching then this morning, let's have a look at those. A reminder of some of the ones that could be on the move. EasyJet out with numbers this morning, more than doubling the dividend. Strong travel outlook, talking about strong progress towards their medium-term goals. So that's in focus. Aston Martin, AML, issuing a second profit warning in 2 months. Delayed delivery of its Valiant models in focus there. They're also raising £111 million by issuing new shares. And they're also issuing some new debt. So we'll keep that stock in focus as we look at another profit warning from them. CD Projekt, the biggest computer game maker over in Poland, of course, refraining from giving any time scale for when the game Witcher is going to be released, but they have moved it to full-scale production, so we'll see how the shares respond to that one, Guy.
OK, here we go. Time for the market open. Time for this Wednesday session, as I argue probably could be the last major session of the week as the Americans go on holiday. There's a lot of business that needs to get done today. So here we go. Final session of the week starts off. Well, let's see how the FTSE 100 opens. In and out of positive, negative territory, but negative territory, red on the screen. We're down by less than 0.1%. We're barely budging this morning. Are we already in holiday mode? Maybe the FTSE is. Elsewhere, the IBEX is down by 0.1%. The Stock 600 is down by less than 0.1%. We're not exactly getting an exciting market open this morning. As we think about maybe what is happening here in Europe and some of the political problems that we are facing, we await the arrival of the CAC 40, Kriti.
And as we get that, we're already getting some of those early prices from individual stocks in the French index, and that looks to be where most of the kind of weight and the pressure is coming from, alongside some of the heavyweights, Anna, ASML, SAP. So you've got that tech underperformance very much built into this market as well. But right alongside it, you have a little bit of luxury, it feels like. LVMH also taking a bid, Total somewhere in there. The story seems to be French underperformance this morning.
Right, and we'll look for the sectors to give us a clue as to what's happening there. Autos and parts is the worst performing sector. Renault is the worst performing stock within that sector. So that gives us a sense of where some of that weakness in Paris is coming from. As you mentioned, technology, an area of weakness. Banks were once again focused on the banking sector, given all the M&A activity that we are at least talking about in Italy. Approaches being made and then being rebuffed. So we continue to monitor that situation. But those are sectors that are lagging today. Basic resources was the worst performer yesterday and finds itself at the top of the board so far this morning. But we didn't see a huge pop in some of those underlying commodity prices. So we'll see if that's maintained through the session.
Tech was down yesterday, and you saw the CrowdStrike numbers. I do wonder whether that's the feed-through into what we're seeing here in Europe this morning. There was actually a fair amount of disappointing tech news from the States yesterday. So maybe that is what ultimately is being priced in terms of why we're seeing the weakness in names like ASML, which is down, SAP, which is softer this morning. The luxury names, are those softer as well? LVMH is down by 0.7%. Some of the oil companies are down too. It does seem as if there's a bit of a safety trade on. You've got Nestle, Roche, AstraZeneca, GSK, all rising. So maybe a bit of defensive bias being priced in to the European market.
Yeah, you're talking about the tech underperformance, and Dell and HP also showing that kind of slump in market alongside the CrowdStrike pictures as well. I want to very quickly mention one stock that has crossed the Bloomberg terminal this morning. That's Grifols over in Spain. It looks like they've got a volatility halt at the moment, but right out of the gates, dropping just shy about 6%. It looks like coming off of a headline that Brookfield is said to plan to walk away from that bid. And this is a really big deal because Grifols is, of course, a largely family-owned business. Brookfield is going to kind of input some of the liquidity into that and make it perhaps a little bit bigger. It looks like they are planning to walk away. They had gotten a little bit of kind of government scrutiny on the back of that as well.
EasyJet up 4%. Let's call it circa 4% on the back of its numbers this morning. Probably the dividend, actually, the bigger factor there in terms of the surprise that's come through. Big raise in terms of the dividend being priced into the stock.
Still waiting for Aston Martin to open on the back of the second profit warning in a couple of months and the capital raise, so we'll wait for that, but probably then to the downside. And CD Projekt down by 1.8% on that disappointment about lack of timing guidance on one of their core games.
Certainly something we're going to be keeping a very, very close eye on. Let's get a little bit more insight on how these markets are performing and how you allocate to them. Caroline Shaw, multi-asset portfolio manager over at Fidelity, joins us around the table. Caroline, we have this debate every morning about what's driving the markets. Is it the weakness in Europe? Is it tariffs? Is it China? Is it the volatility around Donald Trump? What is it for you? What's driving these markets?
It's a combination of all the things you talk about.
You got to pick one, Caroline. Come on.
No, you really don't.
I think off the back of Q3 earnings season, we saw such strong earnings in developed markets. It was another strong quarter, but we saw that weakness in energy and materials across the board, and obviously that plays into some of the weakness maybe in the FTSE with the strength in numbers of the stocks that have that exposure to the commodity prices and the oil price. And I suppose what we saw as the same for Q2 and Q3 was that weakness in China. And that does feed into those European stocks you've been talking about already this morning. And it's one of the key headwinds for luxury in Europe is that Chinese domestic consumer weakness. And we see, we've talked to our analysts on the ground in China about what the headwinds are. And when we look at European luxury, they sell almost a third into China. So if you think about that demand falling off or not recovering, the European luxury names are somewhat challenged by Chinese demographics. We've got a lower birth rate. We've got a lower working population with that capacity to spend. And then we've also got this consumer sentiment that's been pretty weak. So for those European luxury names, that's a real headwind to them.
When it comes to that read-through, though, it does feel like Europe is, again, far more exposed to the China story, to your point. But I'm curious if that should flip. Does that make them, do they start to trade, for example, less off the Chinese fundamentals and more out of the tariff threat out of the U.S.? Do you see that bias shifting?
Yeah, it's going to be a combination of both. And I think maybe the tariff announcements this week that have been, I guess, relatively surprising with Mexico and Canada being brought in just leads to a little bit more negativity around the tariffs for Europe. And so I think for Europe, it's facing not just the luxury sector. Europe as a whole is facing these two headwinds. One is tariffs from the US, and the second is the weakness of the Chinese consumer in a sector that dominates European markets.
And within all of that, then, Caroline, what are you looking? What was the best opportunity that you're seeing out there? We've talked a lot about the headwinds that Europe faces. Are there opportunities within that, or is it not time to find that granularity?
I think if we're talking specifically in Europe, it's quite tricky at the moment. And I suppose from a bird's eye view perspective, we much prefer the US. I think earnings growth is going to be strong still, and we see better opportunities in certain sectors there. One of the sectors we've been particularly favouring is financials, but again, some of the opportunities are in the US rather than in Europe. There are some opportunities in Europe, but it's just got a much more challenging economic backdrop in Europe.
Does that suggest the higher rates environment is investable in the United States if rates aren't going to be cut as much as maybe we thought they would be 6 months ago? Whereas the M&A story that the banking sector is obsessed with here in Europe, maybe that's not quite so investable right now.
Yeah, I think that's absolutely right. I think in the US, certainly the opportunities are not just in the large cap banks either. We're seeing opportunities down into the smaller regional banks. I guess they've got more idiosyncratic stories, those regional banks, but some of those have got really powerful narratives and then also attractive valuations.
Would I buy more bonds than equities if US yields 10 years gets 5%?
I mean, I think that the bonds are certainly somewhere where we've not been as heavily invested in the US for obvious reasons. Yes, obviously.
Yeah.
So yes.
Is that a narrative changer? Does that, if we see yields going up and staying up, does it start to change the narrative around an equity market that's had such momentum over the last few years?
Yes, I think there is a change in momentum there, and there's certainly plenty of people who'd be trading that range in yields as things move up and down. I mean, equities are not. We're not writing off equities. There's great prospects in the equity markets, and if you look very long term, obviously equity market returns should be
even from these
stronger.
levels, you're happy to. You think even from these levels that we are at now, there's upside to be gained.
Yes.
In the United States.
Yeah, I think earnings growth. I mean, what we've seen is downgrades across the board, but those downgrades have been. I mean, globally, we've taken a global view, downgrades across the board, but Europe and the UK have been most heavily hit by that, and China's been particularly weak as well. So the US has not got away with it so much, but there are fewer earnings downgrades in the US, earnings revisions downwards. So in that sense, that's why we prefer the US. Does everything look rosy? No, not everything looks rosy, of course, and certainly from our analyst perspective, when we survey our analysts, and we've got people are on the ground across US, but also across Asia and Europe, what they're seeing is we're seeing higher costs. So labour costs are increasing for businesses and non-labour costs are increasing for businesses. So those are the things we're keeping an eye on because, yes, not everything looks completely rosy given where we've moved to.
Is that where the bleed through into some of these European corporates comes from? And I specifically point to, and I know you can't speak to individual names, but I point to numbers like, or companies that say that are in Guy's Core 6, which is his kind of response to the Mag 7, some of the biggest heavyweights here, ASML, Schneider Electric, among others, Novo, et cetera. So many of those companies have 50, 60% or more exposure to the United States. But if you're talking about a slowdown there, is that where the read-through comes from for the European indexes?
Yeah, I mean, I think we're not talking about a recession, a slowdown is not our base case. So to be absolutely clear, we are expecting some rate cuts next year, maybe not as many as we expected. If we talked 8 weeks ago, this is definitely slowed a little. But we think the economy in the US is the one that will be stronger. When you look at economic growth projections, the US looks a lot stronger than Europe. And so I think for Europe, the read is very difficult because the unknown of the tariffs and the impact of that. And I think, we can all speculate on what those tariffs will be, but we don't know yet.
Yeah.
And, every day there's news flow on that. So the companies are trying to respond in a very difficult environment. At the same point, there is a weakening sentiment in Europe. Economic growth looks challenged. Manufacturing PMIs look pretty grim. And so on that backdrop, with tariffs as that overhang, it's just a difficult place for Europe to be, let alone the need to rally all the countries together to drive the bloc forward collectively.
Yeah, so we'll look to see if we get further signs of that kind of cooperation and coalescing in a crisis. Caroline, when we look at the United States, and there's a lot of thinking about what President elect Trump will mean, and a lot of people come around to the conclusion that it'll mean that he might mean inflation. I was reading some State Street research yesterday that analysed what happened last time around with President Trump and talked about actually there was limited pass-through into the CPI data from what was happening. So maybe some corporates were just taking it in their margins, some were passing it on, but others weren't. Do you expect, broadly speaking, that we will see Trump be inflationary for the US?
Yes, and I saw the same research yesterday, and it was really interesting to look back. And I think there is an element of this time it could be different. And so whilst it's good to look back at what happened last time, the mechanisms and his ability to come in with knowledge about how it all works is very different this time. And it was rumoured that he's got lots of executive orders ready to go, and obviously there's lots of tariff announcements well in advance. So yes, the tariffs will be inflationary. There's no doubt about that. You know, you might see impact like a demand destruction, which you could argue is deflationary. But over the long term, if you think about the ratcheting impact of tariffs, that, you know, maybe you'd expect them to come in and be phased in over a period of time, that will be inflationary. And already the US is struggling to get that last mile of inflation back. So we're already in an environment where you could see inflation sticky where it's at 3%. You could see it re-accelerating, and you could see it in that recessionary type scenario fall, but that is not our base case. Our base case is a reflationary scenario.
Caroline, it's great to see you. Thanks for joining us around the table this morning.
Thank you very much.
Caroline Shaw, multi-asset portfolio manager, joining us from Fidelity. Kriti was mentioning the core six. Let's take a quick look at what it looks like this morning and what we are seeing in terms of the major stocks around Europe. There's only one that stands out to the upside, and that is Nestlé, as I mentioned earlier. Something of a defensive trade maybe into Europe this morning, as you can see. Tech and luxury under a little bit of pressure. Let's talk about some of the other single names we're watching this morning. Joe Easton has the details.
We are going to check back in on Grifols, Guy, because this stock absolutely slammed over in Madrid today. The Bloomberg Deals team reporting that the Brookfield Asset Management Company is moving away from a potential bid for the firm. These headlines were just hitting, as Kriti was explaining. The stock was down more than 10%, coming up very slightly at the moment, down at 7%. Bear in mind, it was subject to a short report, and then we got this deal interest. The stock did recover slightly, but really selling off over in Madrid for Grifols today. Then another stock declining, this one here in London, is Aston Martin. Now, bear in mind, the share pricing in terms of the sale was at around £1 a share. So it's coming down just above that at the moment, and that small downgrade to guidance as well related to the Valiant model, the high-end model. Seen some production issues on that one, so it's a bit of a double hit in terms of AML today, already down by 50% this year. Then one of the very few green stocks I'm covering today is EasyJet. We've got a dividend increase for the UK low-cost airline. Their passenger numbers looking strong, and also getting a boost from that holiday business, which is a newer part of the company, but really helping to push up some profits at that one. So we're up almost 2% for EasyJet in London, continuing to outperform the old rival Ryanair for that one. CD Projekt, meanwhile, slipping very slightly. Now, the numbers look decent, and also they do have news on that new Witcher game, very exciting, coming out soon. We haven't got an exact timing on that. Maybe that's part of the disappointment. Also, this stock trades at around a 30 PE ratio. That's more than double where Ubisoft is trading, so coming down off a high valuation for that one. Then in terms of morning calls, we'll look at Teleperformance first. In fact, with Teleperformance, this does actually have a bit of an M&A deal. They're buying a company that does language services, potentially insulating them from the impact of AI in terms of the customer service company that's been hit hard today, but potentially that payout for that new business hitting the stock. Then we'll do that morning call that I wanted to look at. It is Total Energies. We don't see too many downgrades to this one, but we're falling 1.2% for Total. Now, Exane is saying that valuation on Total is looking a bit too punchy for their liking, given the uncertainty in the energy markets. They downgrade that one after being long-term buyers, and that one falling 1.3% almost over in Paris today.
Thank you very much, Joe. Joe Easton with an equities update, some of the movers and some of the ratings changes. Coming up, we'll stick with some of the corporate stories. Flying high then, EasyJet set to more than double its dividend on a strong outlook. Highlights from our conversation with the CEO coming up shortly. This is Bloomberg.
practically every metric. We have been able to report a very strong progress on that. We have had a record summer beating last year's record summer. We managed to reduce the winter losses in the airline, and EasyJet Holiday, as you know, is growing phenomenally and does very well for us. So that's the reason why we're going from the 10 to propose 20% of returns to shareholders.
Outgoing EasyJet CEO Johan Lundgren, last numbers delivered by him. The full year numbers out earlier today, pretty much in line with expectations. The surprise, the dividend pickup that we've seen coming out of the company this morning, the medium-term targets seem to be pretty much on track. Kate Duffy joins us now, our aerospace reporter. Takeaways? The dividend is the one that the bit that stands out this morning in terms of an expression of confidence in where the airline is going next.
It absolutely is, and there's been strong progress across EasyJet this year in comparison to peers. So the dividend, the more than doubling of that, really shows how much growth that they've had in Europe this year in comparison to the likes of Ryanair and Wizz Air, who've had to really deal with some supply chain difficulties along the way with Boeing and Pratt & Whitney engine issues, and that's something that EasyJet isn't experiencing because of the Airbus fleet and the CFM engines that it's got under the wing.
Guy had some fun with that question to Johan Lundgren earlier, suggesting that this was just lucky, Guy, which I think he rightly objected to.
It was a genius decision by the board to select those engines and those aircraft. He obviously foresaw the Pratt & Whitney engine issue.
Well, there you are. That's the optionality perhaps he left himself with. I don't know, maybe there was none. EasyJet, how do they compare to others then, other low-cost airlines? We've heard from Ryanair. They were very outspoken on APDs post the budget. Didn't seem like Johan Lundgren wanted to go there. What other comparisons are you making this morning, Kate?
Well, if you look at their stock price generally, EasyJet's is up at the moment in comparison to Ryanair's, which is down about 5%, and Wizz Air's, which is down about 40%. So there's a big comparison there. But what we're really seeing with EasyJet is that their holidays business is taking a real boom. There's so much growth there. They're also popping up all of these regional bases across the UK, so that's clearly working for them as well. Whereas Ryanair is saying, actually, because of the APD costs, we might remove routes from the UK. So there's a big disparity there, but in terms of EasyJet's performance, it's been a good one this year.
Very quickly, talk to us about legacy as well when it comes to Johan Lundgren.
Yeah, I mean, so he's been at the airline for about 7 years now, and lots of challenges, lots of successes that he's had to do, such as the takeover of parts of Air Berlin. He's had to steer the airline through the pandemic, and he's also had like a massive Airbus aircraft order, so lots of things going on for him. Yeah.
All right. Bloomberg aerospace reporter Kate Duffy, we thank you so much. Of course, as you're speaking to Kate, we are getting headlines crossing the Bloomberg terminal. Comments coming from, it looks like, Isabel Schnabel, moving the euro, I should say. I'm going to start with the price action here. Euro dollar at about a 105 handle. When it comes to the comments here, it looks like ECB's Isabel Schnabel seeing only limited room for further rate cuts. So you can kind of see how that's going to be moving the market as well. She has plenty of other things to say as well, including that the estimated range for the neutral rate is 2.2 to 3% as well. The ECB may not be so far from neutral rates. There's plenty of other commentary, but kind of moving the market.
So I guess no surprise to markets that she's on the hawkish side of things, is it? But the euro does seem to be reacting to some things. Maybe in the minds of some, it just downplays expectations that the next move we could get would be 50 if you're getting this kind of lobbying from the hawks internally to keep it to 25, perhaps.
There is clearly a debate that is taking place around whether or not inflation has been defeated. But is that really the risk that the ECB is dealing with right now? Is that the challenge that it faces? It doesn't have a growth mandate. It has a single needle in its compass. So inflation is sticky. Even at the margin, maybe the hawks do have an argument. But I find it fascinating this comes out of Germany. This argument comes out of Germany. The economy that is at the centre of Europe and is so troubled right now.
Saying the ECB shouldn't go accommodative on interest rates, as if the backdrop does not warrant accommodative
What else does
policy.
Europe do right now? Where does the relief come from?
She says that, but then she also says that the impact of past ECB tightening is fading visibly as well, and the consumption is stronger than expected, which it almost feels like it's contradictory to the point that you're making.
Let's get an expert for you, shall we? Zoe Schneeweiss joins us, Bloomberg economics editor with analysis. Zoe, help us make sense of just how significant these comments are from Schnabel then. I mean, you know, we might have expected her to sound pretty hawkish, and she does, and the euro responds accordingly.
Yes, as you mentioned, Isabel Schnabel is of the executive board members, and again, she might be a German, but she is speaking in her capacity of as an executive board member. She's definitely the most hawkish here. In a way, it's not that surprising, her saying that they should be gradual. What's interesting here is her explanation why, and that simply is her argument that they're quite close to neutral. So she, as you mentioned, says neutral is between 2 and 3%, and if you look at the deposit rate now, it's at 3.25. That means that she just doesn't think that much movement left. The other argument, she says, is if we cut too much now, there's the danger that we just are wasting our ammunition. And she's saying that really what the issue we have here is that they might be cutting because of things that monetary policy can't actually influence. And that then takes away potential cuts in future when it is things that monetary policy could influence.
It's interesting that I was talking to another governing board member, the governing council, suggesting that maybe we just want to wait and see what Trump does and the effect that ultimately we see coming through from the Trump administration. Wage growth is still relative. There are reasons you could argue that maybe there is still an inflationary impulse within the Eurozone economy. But doesn't it get outweighed, things like wage growth, by the labour? Look at what is happening in Germany right now. The layoffs that we're seeing coming through from key sectors are really beginning to mount up and becoming quite significant. Doesn't that outweigh the risks of slightly higher wages that a rear-view mirror, that's effectively a rear-view mirror effect? I know it will have an effect going forward, but nevertheless, the new news is that layoffs are starting to really pick up.
The issue with layoffs in Germany is that German labor law is incredibly complicated. There might officially be layoffs, but all the layoffs we've seen have been over several years. There are job guarantees at most German companies, which means that even if they say they have layoffs, it means more that if people retire, their places won't be filled again. So that's one of the things where you just have to be a bit patient there. The issue overall we have is the uncertainty created by Trump. Now, we just don't know how strong he'll go on tariffs. We saw 2 days ago he mentioned Canada, he mentioned Mexico, he obviously mentioned China. Europe was not mentioned in there. So that's just one of those things, but we know Trump can be fickle. These things from Trump can come any moment. So the ECB going gradual just keeps the ECB from an embarrassing U-turn or from an embarrassing situation where they've done too much and then suddenly, because of these Trump tariffs, there will be some kind of inflationary impulse again.
Well, an inflationary impulse certainly in the United States, but walk us through, Zoe, just kind of the connective tissue between how that may bleed into the European story. And you kind of hit it on there as well. But in some ways, is Europe insulated maybe from the immediate reaction off of those tariffs?
It all depends a bit how much there's going to be retaliatory action from Europe. So Isabel Schnabel in the interview also said the road to sustainably being at 2% in 2025 will be bumpy. That means that there just are elements here. In a certain way, they're base effects. On the other hand, we know Trump tariffs, in the U.S. will have an inflationary impact. How quickly that feeds through to other jurisdictions is the question. And also, if we last week we had 2 other governing council members on Bloomberg TV. We had Yanis Stournaras, the Greek one. We had the Portuguese, Mario Centeno. Both of those are more on the dovish side. But they all pointed out that, OK, right now it might meet inflationary at the start, then longer-term deflationary. But really, there are so many variables here that I can understand the ECB's cautious stance.
Zoe, thank you very much. Bloomberg Europe economy editor Zoe Schneeweiss in Frankfurt. Just time to mention that we are seeing the markets pulling back on expectations for how big a cut we get in December. 31 basis points now priced in, down from 38. That was the high last week. So we are seeing a pairing of those rate cut bets. Coming up, almost a quarter of the way through the 21st century. Yes, that is the truth. What lessons can be drawn for the future? We will discuss with Deutsche's Jim Reed that conversation, that long view, coming up next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. Red on the screen when you look at the European stock picture, but the real action in the last few minutes has really been in the currency space. I want to go right to euro dollar here, looking at a 105 handle, 105.3 when it comes to euro dollar, all coming off comments from the ECB's Isabel Schnabel, saying that she only sees limited room for further rate cuts. The ECB should not go accommodative on the interest rate story, can gradually move rates to neutral, but not lower. Fairly hawkish take as well, saying that some of the ECB tightening is already fading in terms of the past moves that they've had. This is fascinating that we've seen this actually kind of move the markets and is coming up to be a fairly hawkish read. Now back to a 105 handle on Eurodollar.
The language is pretty strong, isn't it?
Yeah.
She's really trying to make the case that actually this is there is still two-way action on the Governing Council, that there is a debate that is live that maybe would suggest that actually the ECB goes more cautiously rather than delivering maybe the 50 basis point cut that some had anticipated. The kind of the economic backdrop dictates, particularly out of France, particularly out of Germany, maybe an insurance cut around what is happening in terms of the political events in those countries. But she's definitely pouring cold water all over that argument.
Yeah, certainly doesn't sit. From what we were hearing from Zoe a little moment ago, she doesn't see much reason to go much lower, it seems, on interest rates, estimating that the range for neutral is 2 to 3%, and we're not much above that. Right.
Yeah, a lot of that seems to be in response to Trump. The reversal of globalization will have an inflationary effect. We're already seeing those warnings, of course, flood from the banks in the last 24 hours or so after those comments from President-elect Donald Trump over in the States. Let's get some more insight here. We're now almost 25 years into the 21st century. A new report by Deutsche Bank shows that despite all the recent U.S. stock market optimism, it's actually been one of the worst quarter-century performances for equities since 1800. Let's bring in Jim Reed, head of global economics and thematic research over at Deutsche Bank. How much of that underperformance from that is coming from the tariff story, the reverse globalization story?
Well, I think more of the underperformance in relative to history is from the starting point. So 2000 started with very, very high valuations. And also the quarter century we've had so far has actually had some of the lowest economic growth that we've seen in history. So the US, although it's been a beacon in the developed world, has actually grown at about 2.1%, which is a full 1% below the previous lowest quarter century ever. So just lower growth and high starting valuations have meant it's been an okay quarter century for equities, but it hasn't been a standout one.
How does the interest rate story feed into all of that? Because at the same time, in the last 25 years, we've also had very easy monetary policy for the majority of that quarter. Are the next 25 years going to see a reversal of all of that?
I think in the last 25 years, up until the pandemic, you had everything in favour of lower rates in terms of globalisation. Demographics meant there was a surge in the working age population, which meant that wages were kept suppressed. And the orthodoxy was more towards the tighter end of fiscal. I know that with budget deficits high, that wasn't absolute, but on a relative basis, it was tighter fiscal. I think going forward, you've got the reversal of a lot of these themes. So deglobalization, and obviously the tariff story fits into that. Demographics are becoming worse, and I think that's inflationary because you're going to have less working age people, and therefore the price of labour goes up, and if you tie that in with deglobalization, you probably get higher costs. And then on top of that, you've got more money that needs to be spent on defence, maybe the green issue. So unless the bond markets have a complete tantrum at some point, I think the path of least resistance is more fiscal spending.
To be fair, the last 25 years, we've seen the end of the sort of dot-com bubble, which was fairly dramatic, as you say, the starting point fairly high. The GFC, which was basically a heart attack for the global financial economy. We were lucky to avoid a depression and a pandemic. Considering all of those sort of things, I think we've done relatively well, haven't we?
Yeah, I mean, look, over the long run, you would always think equities perform pretty well. You know, they're a risk asset, and in a diverse equity portfolio, you would expect good returns. I suppose what I'm saying is that they're quite substandard relative.
But if you look at the S&P on a log scale, the line just goes from left to right pretty straight. There's a few bips, but there aren't many.
Yeah, look, the S&P in this quarter century had a 4.9% real return. Now, I would have loved to have a 4.9% real return in my own portfolio over the last 25 years. So it's a good return, but the long-term average is nearer 6 or 7. And actually, the UK in this quarter century has had a 2.2% real return, which is the lowest ever.
Kind of feels like that.
Yeah. What does your work, Jim, tell us about thinking on the debt front and how bond markets think about the US stockpile of debt? Because you make the point in your research that the expectation during this past quarter century had been that actually the US would pay off its debts. That hasn't happened. And now there's a lot of focus on, you know, accepting who's in the Treasury, but a lot of focus that under President-elect Trump, we will see perhaps even more debt in the United States. So what do we learn around the debt story?
Yeah, and I think it's interesting to go back on that stat because, and I remember it vividly working in markets in 2000, the CBO, who we all revere as an independent arbiter on debt, the CBO was saying that all US government debt will be paid back by 2013. And by 2025, we'd still have a zero debt to GDP in the US. Obviously, as we hit 2025, we're going to be nearer 100%. So it shows you how the narrative can change quickly. At the moment, it looks like the path of least resistance is that deficits will stay high. Look, the US is in a privileged position of being the reserve currency, etc., so it can probably get away with it longer than most countries. And I think when you've got the debt levels across the world as high as they are, there are likely to be disturbances.
Yes.
It's very difficult to predict where, but I think with debt levels this high, there probably will be crises going forward.
So there might be crises elsewhere, but you don't anticipate anything on the US doorstep because of its, you know, exceptionalism and reserve currency. But is there anything that tests bond vigilantes' willingness to support the US debt market?
Yeah, it's not going to probably be the first port you go to. I think if you look at the CBO forecast, which I've kind of dismissed a little bit from 2000 onwards, but if you look at them going forward and you look at some of the numbers, inevitably at some point there's going to be a question mark about the sustainability of the US debt. And maybe in the background you see term premiums slowly rise in the background. And I suppose that would be a risk, that if yields get to a point where they start to crimp economic growth a little bit, then that might be a signal that the US has gone too far. But I think there are other kind of dirty shirts that probably get hit first.
Okay, so can we zero in on that long end as you're talking about the term premium, but I'm curious about the ripple effects into the end U.S. economy, and specifically when it comes to the housing market in the States. We were talking in the last couple of years about, does the housing market crack at some point? Are property valuations too high? And although prices are coming down, how does the maybe volatility around the budget and the long end of the curve ripple effect into the housing story?
Yeah, it's a bit of a mystery because I suppose we've never seen a situation before where the market has evolved towards a 30-year fixed mortgage in an era of 20, 30 years where yields have only come down and down and down. So you get to a point 2 or 3 years ago where everybody in the US pretty much was on a 30-year fix with maybe a 3 handle.
Yeah.
And today, that if you wanted to remortgage today, it's 7%. Now, luckily, there's not much turnover in the housing market in any one year, so not many people are exposed to that. But I suppose if you look at it over a 10-year period, everybody has to move. Well, the majority of people have to move house for some reason, family, jobs, etc. And I suppose the longer rates stay higher for longer, the more you kind of bring into that higher rate environment. So it's more of a slow bleed rather than a sudden risk. I think the sudden risk would be if unemployment went up, and at the moment that's not on the horizon.
Well, ask this in the context of when we saw it in the third quarter of 2023, we saw that volatility on the long end, and Andrew Bailey and the BOE spoke about it. We saw Governor Ueda, the BOJ, speak about it as well. And it was a term premium story, and it was a budget deficit freakout story. But then to your point, it kind of slowed, and it was short lasting, so we didn't see the ripple effects. In January 2025, we're going to have that happen yet again. And I'm curious how long that kind of volatility has to last in the long end of the curve to see actual impact on the economic front.
Yeah, look, I think where the US and other developed countries have been fortunate is that with the initial COVID wave, rates got to absurdly low levels, and there was a lot of refinancing done in the credit market, in the housing market, across the road. So as rates have gone up, there hasn't been an immediate desperate need to refinance. But as I said earlier, I suppose the longer rates are higher for, you kind of slowly drag more people into that. Now, the hope would be that economic growth and earnings growth and income growth kind of absorb some of that. So I suppose the longer you push it out, the more you've got a chance of having economic growth kind of grow into it, if that makes sense.
Jim, really great to read your research and to think about these long-term trends, because I wanted to ask somebody, and you seem a good person to ask this, about the sort of growth model that the West has when we see population population struggling to replace themselves in many Western economies, really low birth rates in many Western economies, and what that means for GDP and our ability to support those dependents in the population. I mean, is AI the only secret weapon we have on this front? Is that going to be enough?
Yeah, I mean, in the report, one of the things we highlighted was that, before the last few years, there's very few countries in the world that have ever had declining population or declining working population. Whereas in the next quarter century, of the 57 countries we analysed, around about half have got a working age population that is going to fall. And if you look at the developed world, it's 16 out of 24. So, 2/3 of countries in the developed world are going to have their working age population fall. And we've done some nice analysis in the report saying that there's a very strong correlation between working age population and economic growth. It's a very simple, obvious correlation, but I think it's worth highlighting. And it's not only GDP, it's GDP per capita. So there are some arguments out there that suggest that it doesn't matter so much if your working age population fall and if you don't have migration, because you can raise the pie for the existing population per capita growth. But our analysis also showed that per capita growth is very correlated to working age population. And I think it makes sense because if you've got a strong working age population, you tend to have a more dynamic workforce. And also, if you've got a strong working age population, you can pay for your elder population. Whereas
that's all the problems. Does AI get us out of that?
Sorry. I went on a rant.
That's good.
AI, I think, is probably the first thing I've seen in my career that I actually think could be productivity enhancing. Most of my career is spent looking at productivity going down and being quite depressed. And I look at AI and I think there's a chance this could be productivity enhancing. Now, I don't think any of us know, and there's a lot of internal debate at Deutsche Bank, how much that productivity enhancing would be, but I think it could be.
It's interesting. So the bit that really caught all our eyes this morning was your technological progress table, which made us chuckle quite a lot. So you've kind of gone through items that were big in previous decades and maybe are obsolete now. 75 to 2000, 8-track tapes, carbon paper, Polaroids, Kodaks, punch-in cards at work, though I would argue we've still kind of got the technology.
You've got that at Bloomberg.
We've still got that here, effectively. But if you go from 2000, it's blockbuster videos and VHSs and things like that, which I remember fondly.
Yes, start of our work career. Start of our work career was all VHS.
Yeah. Or Betamax, which was the argument in our house. So.
What do you miss the most out of that list, Jim?
Sorry, Becky?
What do you miss the most out of that list?
Kriti doesn't know what half of these things are, by the way. So
I did spend a lot of time Googling this morning.
Floppy disks, for example.
Yes.
To be fair, I would like to think of myself at the cutting edge of technology, so I don't miss my VHS tape that used to get mangled when I used to pull it out of the...
when you watched it too many times?
Yeah, when I used to record the sport and then find that my parents had recorded something else.
Or not recorded the sport. Do you remember the timers? You try and set the timer and it would never used to work. Nokia phones, quite miss those.
I miss Snake.
I really miss.
I miss Snake. It was a very good game.
You see, now we wonder where the productivity went. And we look at the list of social media on the left-hand side of your of this graphic, Jim, and I'm
trying to enhance my children's productivity with a phone in their hand is quite difficult, I would argue.
And that I think it's a serious point, because sometimes some of the technology we've had in the last 25 years, you could argue is productivity damaging, because it just takes away a lot of time. Now, maybe you could argue that to get to the AI productivity boost, you need all this kind of infrastructure of the internet, and maybe the next wave is the productivity enhancing stuff. But that's the optimistic slant on it.
Kriti genuinely had to Google what a floppy disk was this morning.
You know what? I'm going to take pride in that. I didn't know.
There's plenty of new tech that she knows.
I'm still learning the new stuff. Come on. I don't print my notes. But Jim Reid, head of global economics and thematic research, we thank you so much for joining us from Deutsche Bank. That's a longer conversation. In the meantime, let's talk about a stock that is moving and is quite significant this morning. Grifols had another volatility halt, I'm going to try to say, down about 10% now. This after comes with an update from the Grifols family itself that it will not be backing another take-private deal. This, of course, comes after Brookfield, which was going to help out with some of their liquidity story and revamping the company, said that they are going to walk away. Looks like a disagreement on some of the pricing and the valuation. Much more ahead. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We are 48 minutes into a session that has a significant downside for some of the markets in Europe. The FTSE 100 outperformed a little this morning. The CAC 40, certainly the worst performer, down by more than 1%. And it's quite broad-based, that underperformance in Paris. We have some of the financial services names like AXA, BNP Paribas trading weaker, but also energy names, Total Energies, Schneider Electric, and construction as well. So it's broad-based, that retreat we see as we watch the French politics play out, perhaps. Let's turn to matters geopolitical, and a 60-day ceasefire between Israel and Lebanon's Hezbollah is now in effect. Overnight, Iran said it welcomed the agreement and reiterated its support for Hezbollah. Israeli Prime Minister Benjamin Netanyahu said the deal would allow Israel to focus on, quote, the Iranian threat.
I am determined to do whatever it takes to prevent Iran from obtaining nuclear weapons. I have said many times that a good agreement is an agreement that is enforced, and we will enforce it.
Let's bring in Bloomberg's Jumana, who joins us now from Dubai. And we've heard great news about the ceasefire, of course, Jumana, but we're already seeing voices talking about what happens if there are truce violations. And so I suppose whether this holds is going to be one of the first questions people are asking.
I think that is the main question that people are asking, Anna. And certainly there are lots of words of support and encouragement coming through from some of these regional leaders, international leaders, very happy to see that a ceasefire agreement has been actually agreed to from both sides. But again, let's just review what the ceasefire is calling for. It is temporary in nature. It's going to be only 60 days long. And the terms stipulate that Israeli troops have to gradually withdraw from the southern border of Lebanon. This is a gradual phasing out of troops, it should be stated. In addition to that, Hezbollah also are required to retreat 30 kilometers away from that so-called blue line demarcation as well. So key here is going to be implementation. And inherent to that means that there will be an international panel set up to monitor compliance with both of those components of the treaty, in addition to the deployment of Lebanese troops from the Lebanese armed forces, supported by a UNIFIL peacekeeping troop as well. So there will be a lot of monitoring on the southern parts of the border to make sure that both sides adhere to the agreement. But here is one statement that I think is worth flagging. The Israeli Prime Minister, and you just played a comment, said that if Hezbollah breaks the agreement, tries to rearm, we will attack. So they want to preserve the right to continue to hit Hezbollah targets should there be any breaches. So devil in the details as ever.
Jumana, Netanyahu also talks about the idea that this would leave Israel able to focus on Iran. What are people saying about what that means?
Well, I think it's interesting in the context of also a new administration coming into power in the U.S. By the end of January. It's no coincidence that this is a 60-day deal. And if you do the calculations, that takes you towards the end of January, by which time President Trump will be in office. And he held a call. One of the first calls he held, actually, after winning the U.S. election was with the Israeli Prime Minister. And they talked about the threat that Iran poses. And we know that the Trump administration, the people that he's nominated to represent the Middle East and be his Middle East envoy are quite hawkish on the Iranian threat as well. So also, you have to think about the timing of the ceasefire deal and the fact that Iran have actually found themselves on the back foot. Their proxies in the region, Hezbollah, have taken and sustained blow after blow. Hamas, extremely debilitated within the Gaza Strip and almost not recognized amongst Arab states. And Iran itself reeling economically and politically. You're even hearing motions from the Iranian president saying that they're willing to engage with the West again to increase the possibility of perhaps removing some of those sanctions. So all of this has to be taken in light of broader developments in the region as well. And the hope is that the ceasefire in Lebanon and Israel could actually be transformed into perhaps a bigger ceasefire, more comprehensive ceasefire plan in Gaza as well.
Bloomberg's Jumana Bersetchi, our anchor over in Dubai. We thank you so much for joining us this morning, giving us that crucial context. Certainly something we're going to be watching very, very closely in the days and months ahead. In the meantime, let's talk about what we're going to be watching in the hours ahead. At 9:30 a.m. UK time, German consumer confidence is going to be hitting the wire. At 11 a.m., it is that approval vote over in Brussels for the new EU Commission. And then a little bit of a data dump over in the States at 1:30 p.m. UK time. Third quarter GDP, initial jobless claims And, of course, the U.S. core PCE coming in 90 minutes after that, about 3 p.m. UK time. A lot to dive into, but I think the PCE data may actually take the cake. Due later today, expected to show a pickup in U.S. inflation in October from a year earlier. Valerie Teitel joins us around the table. Val, walk us through that PCE preview.
Look, there is a risk that this does have quite a jarring effect on the Treasury market, especially on the front end, because we're still pricing a 50-50 chance of a December rate cut from the Federal Reserve. So perhaps a hot print today could tempt the market to totally price out the rate cut, or exactly the opposite. You know, we do see as we head into one of these Fed meetings that pricing does go one way or the other. Maybe today we'll get that reading. But looking at the EcoGo screen of what drops at 130, probably gives people a heart attack. We also have wholesale inventories, durable goods. We get a Chicago PMI as well, and then we get the big GDP data. So there is a lot of data dropping today. The big one will be the 3 o'clock PCE index.
Yeah, it almost fills the screen just peering over your shoulder there, Valerie. So you were taking us through a chart earlier on that was really interesting, which was around consumer optimism, specifically around stocks. Valerie, we put this to Mark, and he was saying, yes, you could, if you were a bear, it could make you question what you're doing. But if you're a bear, you could also use it as a sort of contrary indicator and saying, well, if everybody's getting into stocks, maybe that's not such a good sign. Did it surprise you?
It did. It really did. Because if you look at just how much it jumped in the last month, not only did we take out the highs that we saw around the discussion of the previous tax cuts back in 2018, but it is at a clear record since the data began in 1987. But this goes back to the same playbook that we had last time Trump came into office. We saw a surge in small business optimism, the biggest move that we had in 40 years back then. It looks like we're getting hints of that, in the data already. Consumer confidence, business optimism, bullishness about the stock market, it all weaves into the same playbook that we maybe got last time.
Is the cost of this high yields? Because that's what the market's also getting ready for.
Clearly the market read through the tariff announcement yesterday that it wasn't going to be negative for growth. I think that was the main takeaway, is that the cost of this still doesn't, or if you can view tariffs as perhaps the downside risk to growth that the Trump administration puts forward, the market is clearly more focused on the upside risks rather than the downside risks. The other thing that I thought very interesting to see today is we get a hawkish ECB. This unwound a lot of the dollar strength that we saw on the tariff announcement, and that's going to be important for Trump, right? Because the more he talks about tariffs, the stronger the dollar is going to be, and that's going to more complicate his second agenda of trying to move manufacturing back to the U.S. So, this downwind that we've seen in the dollar on this hawkish ECB comments does maybe give him more room to be a bit more hawkish on the tariffs narrative.
Okay, so those are the big macro things hanging over the markets today. Valerie, thank you very much. Valerie Teitel with the latest there. Delivery Hero, just a quick update on a stock-specific story. We're getting news out of the German-listed food delivery business. They're upsizing the Talabat IPO. This is the food delivery business in the UAE that they have been planning to bring to market. They see proceeds now between 1.9 and 2 billion US dollars. So that is something we're going to watch. IPO activity, that's exciting to watch. We've had talk of a couple of IPOs this morning, so that's something for the corporate bankers to get excited about.
Yeah, just when we thought that some of that deal market activity would be increasing, it kind of feels like a little bit of hesitation and a little bit of a pullback as well. Some of that may have to do with the macro conditions, of course. We're talking about the U.S. story, the European story. Maybe not the best time to be making deals, at least some would argue. Coming up later today might just be a conversation with Nouriel Roubini, CEO of Roubini Macro Associates. That coming up at about 5 p.m. UK time. It's not a conversation you want to miss. In the meantime, these markets do look a little bit mixed. Currency volatility front of mind. That does it for the opening trade. The Pulse is up next. This is Bloomberg.